You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
Welcome back to the Advisor's Option, the program here on the Options Insider Radio Network, where we break down all of the interesting developments in the world of options, as well as how these things actually work, and explain how you guys out there in the active advisor and asset management world can use them in your own portfolios and your own client portfolios. My name is Mark Longo from the optionsinsider.com, as well as, of course, from the ever-expanding, ever-exciting Options Insider Radio Network. 13, soon to be 14 programs on said network, the easiest place for you guys to find them all. Of course, the mothership, the flagship, theoptionsinsider.com. Click on the Insider Radio Network tab, and you're off to the races. All 13, soon to be 14 programs pops up there for your listening pleasure. Of course, also iTunes and Stitcher, TuneIn, pretty much everywhere else you find your favorite podcast programs, as well as, of course, our own mobile app available in the iOS and the Google Play, as well as the Amazon Fire Store. So no shortage of ways for you guys to download and stream the shows. And while you're listening, of course, we'd love to hear from you. So send us your questions, your comments, your feedback. You guys, after all, are the reason we do this program. And speaking of this program, we're going to do something that's a little bit different. We may sound a little bit different, sorry, because we're not beaming to you from the Options Insider Studios in sunny Chicago. We're actually in a little bit sunnier place right now. We're in scenic and sunny San Juan, Puerto Rico, for the first annual Swan Global CIO Conference, a very interesting event, kind of bringing together a lot of different participants, as the name implies, a lot of CIOs, asset managers, traders, and others in this area who are interested in the interplay between options and the fund universe and advisors and a lot of the other interesting things that we talk about quite a bit here on this program. So we thought it was worthwhile to come on down here and check it out. And now that the conference just wrapped up a few minutes ago, maybe you can hear some of the hotel staff cleaning up there in the background. So we're fresh from the conference, and we have a lot of interesting thoughts on this event. And I'm joined by a triumvirate of the Swan team here, starting off immediately to my left with Marc Odo, of course, of white paper fame / infamy here on the program, as well as Micah Wakefield, also of recent white paper fame/infamy on the program, as well as Chris Hausman. He's also been on, but he hasn't, no white papers, I don't think yet, right, Chris?
I have some fame, though.
There you go. Fame/infamy all around here. On the table. So I thought it'd be good. Like I said, the conference just wrapped up. It's all kind of fresh in our minds, kind of some interesting takeaways. I have my thoughts, but I'll let you guys, I think, maybe kick it off. Maybe I'll go in order around the table. Maybe, Mark, we'll start with you. You presented your paper, your very historically allegorical paper on cutting the Gordian knot there, and some interesting takeaways. So first off, what was some of the response to your paper here, as well as some of your other takeaways from the conference? Could be some of the other sessions, interesting nuggets you may have overheard or talking to people in some of the networking receptions. What were some of your key thoughts on the event?
Yes, thank you. Well, specific to the actual topic I talked on there, the retirement conundrum, the reception was very good. It was very well received because I think it's a problem that many, many people are dealing with. As everyone knows, the baby boomers are marching off into retirement. Every day we have more and more people getting Social Security and retiring, and their financial needs are changing. So they're doing it, unfortunately, in an economic environment, in a capital market environment where they're faced with many, many challenges. Bond yields are very, very low. Historically, bonds have fulfilled two roles in the portfolio, that of safety of principal and income. And with bond yields at 2% and yields going to eventually rise, that traditional role that bonds have played in the portfolio is under threat. Now, if you think of your standard 60-40 type portfolio, that bond allocation is made up traditionally about 40% of your portfolio. Well, what's the other 60% then? Well, that's typically equities in your traditional portfolio. And as we all know, the markets have been pretty rocky here in 2016. They're at all-time highs. Where we go from here, who knows? So the standard 60-40 solution that might have worked so well for someone over the last 10, 20, 30, 40 years is probably not going to work going forward. And this is a topic on everyone's lips. I mean, it doesn't matter if you're an institution, if you're managing a pension or an endowment, or you're for an individual who's in that retirement phase. You have this challenge of meeting those goals and funding the next 20, 30, 40 years of retirement. So, you know, what we're proposing is that using options to fulfill those roles of safety of principal as well as income generation. So lots of thoughts around that. It was good. We had lots of good conversations.
Any other sessions or topics that kind of catch your eye here at the event?
Well, what was fun about this event, it was a two-day event down here at the Condado Vanderbilt Hotel in San Juan, Puerto Rico, is we got to see all the different elements come together and everyone lend their expertise in this two-day event. You think about all the different components that go into this type of investment strategy to make it work. You know, we have the options themselves, but options are always pegged to some sort of underlying investment. Okay, so what are those underlying investments? In our case, we use ETFs. Now, of course, you can have options on all sorts of different topics, or excuse me, different underlying products or assets, but in our case, we're looking at ETFs. Now, of course, the ETF industry itself has evolved massively over the last 2 decades. We're at, what, 3 trillion, I think is the number I heard, under assets under management in ETFs now. So we had some industry leaders and some experts just talk about the ETF as a solution and how that's evolved. But let's dig a little bit deeper. I mean, ETFs are typically based upon market indexes and this whole concept of indexing and what's the best way to have some sort of proxy for the market. So we had some people from MSCI and S&P come in and talk about, you know, their approaches to indexing, different variations, different tilts. And then, you know, once we design the strategy, pulling all these different components together, then it has to be taken out to the market. And we have to talk about what kind of needs this is going to address. And that was a little bit about my role there is, you know, what kind of role do these option type solutions fulfill in a portfolio. And even after that makes sense, there's still the problem of getting the end investor comfortable enough and educated to understand that, oh no, this is actually a cleaner, better way of doing it. And some of the stuff that my colleague Micah put together helped illustrate and illuminate that very well. But those were the topics, and we came at this topic from a variety of different angles, and I don't think we left a stone uncovered.
Well, Micah, since he invoked you, you get your pride of place here next here on the show. But of course, the same question for you. It's been an interesting couple of days down here in Puerto Rico. You've just this morning actually presented your paper that you discussed on our program on a recent episode. So same things to you. What was some feedback you got from the attendees on what you presented, as well as some other thoughts and topics that leapt to mind over the course of the conference?
Oh yeah, that's right. I think that. The responses, some of the responses I was glad to hear was, you know, I was thinking, as I think I described on the last one about the paper, which discusses the importance of math and investment returns, that it was going to be too simple. Some of the concepts seem so simple to us, but the overarching concept was, even though these are simple concepts, clients have a hard time, investors have a hard time understanding the importance of them. So it was good to hear, even from one of the guys from the OIC just saying, hey, these are concepts that we really need to get out to people so they understand them. And my response to that was, well, it's options that really structures the types of things that people need to understand about math. Because one of the main points I discussed before was avoiding large losses, which I think the more I think about it, the more I look at it, the more I discuss it with people at this conference. That is really the key one of the four concepts: the power of compounding returns, avoiding large losses, volatility drag, and distribution of returns and how that matters. But avoiding large losses is really kind of the key one. And I think anybody who's trading options or who uses options in their investment management, kind of understands that a little bit, how important it is that they are disciplined in their risk management. That if they're trading something but they're not, trying to really make sure they have a plan in place to cut their losses short, as traders like to use that phrase, that can end up over time, really having a big impact. And a number that I didn't mention the other day that I did earlier in the talk was, this concept that, if you say you're down 10% in a trade or in a strategy, you need 11% to get back to even where you were. But if you lose 90%, you need 900%. And something that I saw recently was, if you're down 99.72% though, which is actually the return of the VXX, which is a pretty common,
good old VXX,
pretty common short-term trading vehicle nowadays. If you've held it to its inception through the end of the quarter, at the end of March, here in 2016, you need 35,600% to break out back to even on that sucker. So that's good. That's the exponential power that occurs if you don't avoid losses. So.
That was a great chart, and that one kind of caught my eye, and I could see a lot of people, I think, kind of perked up in the room when that one came up as well, because it is so stark to see just, you're right, that little bit of a loss, and then you get down towards the VXX type numbers, and it's an exponential path back to return. Ironically, someone at the conference did stop me and ask me, completely unrelated to this, about VXX puts, and was that a long-term VXX puts? Was that as much of a slam dunk as it seemed? He didn't really believe it. He thought it was too good to be true, and so that gets kind of what you were just talking about. If he had bought and held VXX over, what was it, 5 years on that chart?
Yeah, 2011 was the inception. So, of course, I mean, that product, Chris can probably speak to that more so from a trading perspective. As far as how the options get priced, it's not like you can just buy a put in 2011 on VXX and expect to have fantastic returns, because it crashed 99.72% over those 5 years. But there are some particular option strategies that people could take advantage probably of some of the products like that. And maybe you can speak more to that, Chris. But yeah, overall, I think it was a really great conference. There was some great content, having experts like from the OIC and other people experienced with 30 plus years experience in options and the markets, just having that expertise here, getting to talk with those people, hear them, ask them questions, stuff like that. Really enjoyed that. Some of the things that were said, I think, were really interesting. Some of the things I was jotting down. I mean, no idea. 27% of option volume is now in the weeklies. I mean,
That's
wow, 27%. That's quite a large amount.
There you go. A new leg of the Swan is in the weeklies now.
Yeah, and expect that number to increase.
Yeah, we don't play in that realm very much at all. But obviously, it's become something that more people are using, coming more comfortable with, and how they're structuring their strategies with options in the short term and the long term.
Well, maybe next time we get you on the show, there's so much. You guys like your data and white papers. There's so many papers and studies coming out just recently in the last few months, all about essentially that same topic: the efficacy of weeklies versus monthlies from a premium harvesting perspective. A lot of them coming out of the SIBO because they have a lot of skin in that game, obviously. But have you guys had a chance to check those out? This is unrelated to the conference, but Micah brought it up, so I blame him.
Well, the one thing I was just going to add, it actually tails on to what Micah's comments were about the 99% loss in the ETF there. And point, I say it's now time to start worrying about tax loss harvesting and not wait for 35,000% return. That's the only thing I was going to throw.
It's more of a, I think it's more of a theoretical. That makes for a nice graph. That's what it is. If anyone actually tries to do that, you're right.
Yeah,
they probably have
not that I'm a tax advisor, but
other issues involved. All right, Chris, we'll turn the tables to you now. Same question. What were your thoughts? It's been an interesting, action-packed couple of days down here in San Juan. What really kind of leapt to mind for you here at the conference?
I was actually pretty impressed with the diverse array of participants here. So we had people from State Street, S&P Capital, IQ, Aon Hewitt, and I'm just naming a few. So I moderated a panel that was kind of more option specific, and it was the first one just to kind of kickstart, because we have an options overlay program. So just kind of kickstart and get everyone lukewarm with options, because again, it has transgressed from a voodoo topic to more mainstream, acceptable, manageable asset that needs to be part of people's portfolios. So on the panel that I moderated, we had representatives from Convergex, OIC, and Wallach Beth Capital. So we talked about the role of education, how there's just a lot more resources today to learn about option strategies. And the more education, the more you know, the more comfortable you're going to be with something. And I remember when I first got in the business, probably about the same time you did, Mark, what was the one book you had to read, right?
Natenberg.
There you go,
was the one
Bible.
they handed you when you walked in the door.
You had to know that one inside and out, and but that can be a kind of a technical read for most people. So
It's good reading late at night, I find. It helps you
go to sleep, does it a little bit?
Close out the day.
Yeah. So education has transformed. I think there's better instructors out there. They're teaching a little differently and honing in on the topics, not so much kind of like the market maker education that we got when we were trading on the floor. So it's made people comfortable using options. In this yield environment, people are searching for additional yield and strategies, and options is a perfect way to go in there and try to seek that. So it really comes down to education, being able to manage these assets, if you will. And I'm going to call them assets now. I'm not going to call them speculative vehicles. They're assets to a portfolio. And we also talked about liquidity. One of the issues that we always have is, okay, you guys have phenomenal growth, great strategy. Well, what about tomorrow? Can you continue to handle this growth? And we trade highly liquid products. Frank Tirado from the OIC talked about the phenomenal growth in options, and that growth is expected to continue, again, with education and more participants entering this field, because there's still a lot of people out there that can tap into the options world and continue to grow and manage their portfolios, et cetera. So we talked about some, there's 14 option exchanges. I asked the question, are we going to have 25, 30 in a year or two? The answer was maybe, probably. It seems like
that answer actually kind of surprised me a little bit, especially given the recent potential consolidation we're seeing there with NASDAQ, essentially lumping 6 options exchanges under one umbrella there. It seemed like on your panel, at least, there was the view that that's going to be de rigueur going forward. Everyone's going to have 6 now.
Everyone's going to have an exchange. So
why have one maker-taker model when you can have 2?
There you go. One will work, right? Yeah. One's going to work. So as far as liquidity and growth, we're not going to have any issues. We're going to grow with the business. The business has grown with us, and we expect that to continue.
You mentioned some of the issues you guys brought up on that panel, and you're right, that was an interesting panel. Obviously, that's very much in my wheelhouse, that session, so I enjoyed that one. Have any of those issues you guys touched on the panel, the fragmentation and things? I'm assuming there's a reason you brought those up on the panel. Is that something that comes up a lot with clients when you're talking to them? Do they see these kind of top-level issues with the options world? They say, hey, I hear the stuff's really fragmented, or does that come back to you a lot from clients?
Well, I think the issue is when you're trading size, you see a posted market. Mm-hmm. You see an MBBO, the National Best Bid and Offer. And if you haven't been in the game, if you haven't been a market maker, people are going to assume for the most part, hey, I should get 20,000 contracts on the bid. I should be able to do 50,000 on the offer. Exactly. I think once upon a time when volume and liquidity and multiple listing in 2007, 2008, there were more liquidity providers and they would hold the MBBO a little bit better. Nowadays, you've got much better markets, and it's been good for us because the cost of trading and execution has gone down tremendously. But we also have to use our skill that if we know we have to do a certain block, it's not going to be on the posted bid, all of it. Or it's not going to be on the posted offer price, all of it. So that's where our experience comes in. Hey, there's actually markets outside of markets. There's the inside market, the outside market, and then the outer rim market. And we have to know and navigate through that with the kind of size that we do. But again, we trade highly liquid products. Execution's never been an issue. Another member of our team is an ex-floor market maker as well, so we know quite a bit about executing, and we're executing against our former peers, right? Guys that we traded with on the floor. So we know what they're thinking. You know, we know how to play the game just like they do. So it's been an advantage for us. And so the fragmentation issue really came, it wasn't from our end, our perspective as far as getting filled on orders and what we trade, but it was more that a Convergex or a Wallach Beth, they're challenged, I guess, or they have to work a little bit harder nowadays to find liquidity because the pool of providers has decreased so much. So one of the topics we discussed is, well, how do we get more liquidity providers into this business? You know, they've got to make.
I was surprised to hear that topic come up because that's a very contentious topic these days. It comes up a lot at industry events, and you're right. There are a lot of interesting proposals out there to do that, and a lot of them, none of them have really gained any traction yet, as we've seen from the exodus in the market making world over the last.
Yeah, absolutely. And I kind of think maybe in some products it's hurting because there's all these new products being listed. And I think some of them are falling short of the mark on volume and open interest numbers that they would like to have. So we're starting to see that. So it's like, you know, well, maybe we need to incentivize some new liquidity providers, i.e. market makers, to come back in and, you know, help with all these products, especially if we expect this continued growth, right? If this growth is just going to keep going and going, well, there needs to be someone else down there to take down these orders. Not that it's an issue right now, but, you know, we have to think down the road, right? Be proactive.
One of the issues they brought up on the panel that I've heard brought up before too, one of the things that's been developed in recent years to kind of help try to address that situation is, of course, the auctions and the prevalence of auctions out there. That's kind of a way for, you know, market makers to not really show their full hand, you know, to come in and then then the order comes in and then they hit that. But that, of course, makes your guys' job a lot more difficult because the markets you're seeing displayed are not, you know, the true intent out there. There's, as you said, there's kind of size behind that and size lurking in other areas of the market. So talk about that a little bit too, kind of the impact that's been on you guys and the strategy in general and then the climate, you know, just the prevalence of auctions, and it seems like they're not going away anytime soon, and just that trend towards maybe adding more functions, you know, in a noble effort to try to help protect the market makers, but in so doing, kind of makes your job on the other side of that phone a little bit harder.
Yeah, again, we trade pretty liquid products, so we haven't seen any type of impact as far as that's concerned. I'm sure everybody would agree here on this table that we'd love everything to be out in the open outcry. I mean, this is a world of transparency, and we don't want to have to deal with auction markets and anything that's kind of behind the door, if you will. But if it's something that we have to deal with, I mean, we definitely have the expertise to transact, and I don't see any impact on our strategies and our performance in any way, shape, or form. You know, we've like I said, we've grown with the options business, and we expect it to continue moving forward.
Well, I don't know if this is related to this thing, but Chris, to ask you a question on what you're talking about there, you know, I've seen some stuff out from, you know, someone that you and I look at frequently, the great data analysis from Nanex, and they're saying that option quotes are now at all-time highs, record highs. You know, I'm seeing here that a record 23 billion in one day in January was the new high for total option quotes. So we're talking about how there seems to be less market makers maybe in the market, but somehow there's a whole lot more option quotes that's going on. What's your take on that?
Well, so it's a relative thing, right? If we didn't have all those option quotes, then there wouldn't be. Well, we need more. Maybe that number is scaring people, and like, wow, do we really have enough people, market makers out there to handle all these quotes? Now, so is technology just getting faster and faster and better to where the human element of actually making these markets and taking this risk? You know, the computer can trade, but who's managing that risk? Is the computer really managing that risk? I mean, who's the guy who's saying that this is too much for the firm? I mean, is everything black box? I don't think so. I don't think everything is black box just quite yet. So it's, you know, more products are going to be listed. That's what exchanges do. Their model has changed from a person that rented or purchased a seat lease to shareholders. And we all know what they have to do if you have shareholders, right? It's all about the bottom line, and that's fine. So they're going to innovate, they're going to help us, they're going to educate, and that's great, and they do a fantastic job about it. But it seems like people may perceive it as a little taxing on the market makers with all these quotes, and like, wow, there's too many markets out there. So, you know, it's like it's a contentious issue, like Mark mentioned, and it's something that we're going to have to keep an eye on, but.
That kind of goes back to what we were talking about earlier, too, about the prevalence and the proliferation of trading venues. Because, you know, if you're one market-making firm and you're putting out quotes on Apple and you're just doing it on ISE, you know, that's your one. Now you have 13 other exchanges, so, you know, times 13, and there you go. That's a good reason for why we have so many quotes out there as it is right now. So many people trading the exact same things on multiple myriad different venues, all having to stream and quote and update simultaneously. It's been an interesting. We also do obviously a trading tech show on our network, and trying to see the hardware evolutions and things they've done to keep up with that, particularly from an options perspective. Some very interesting stuff on GPU centric technology and other things, trying to just focus on how do you display and update so many series simultaneously with every tick of an underlying and a name like Google and everything else. It's been a fascinating issue, and certainly we're not at the end of that anytime soon, at least until that number of 14 starts to come down the other side maybe. And I guess I probably agree with the panel. We might probably see a few more, I think, before we start seeing a few less in that regard. Well, a couple other issues I think kind of caught my ear here at the panel. One was just the one at the conference. One that was the most recent sessions of this morning, kind of comparing and contrasting the ETFs versus the futures from an execution perspective. That's kind of a topic that isn't really bandied about that much. We'll talk about roll yield and some of the products. We'll talk about some of our programs like products that are extremely disenfranchised from it, like you mentioned VXX earlier, and the contango nature of the VIX futures term structure. Right. But he was also kind of comparing and contrasting in his charts to the management fees on a lot of these ETFs. And he's an ETF guy, so surprise, surprise, the ETFs usually won. But he did, to be charitable to him, he did point out that it wasn't always the case, and it varies widely depending on the quarter and the term structure of the future you're looking at. But I'd be curious if that kind of resonated for any of you guys either. Is that an issue you guys look at a lot here, and comparing and contrasting, a large future and using, let's say, an S&P future maybe in your case versus an ETF or something along those lines?
Yeah, we have looked at that. I've seen some other studies besides some of the data that BlackRock was showing as it relates to ETFs and futures. And to his credit, yeah, he's right. Most of the time, it does appear that ETFs can do a really good job of that, and there are on occasions where futures can perhaps be a little more cost effective. I've kind of seen studies going both ways. Probably one's done by somebody from the ETF industry,
and BlackRock has the ETF study.
But when I've looked at those various studies, there are other factors just besides that. And generally, I think that our focus, of course, and our expertise has been in ETF space. From a number of standpoints, it's easier for us. From a regulation standpoint, from the standpoint of not having to deal with the contango and backwardation that can occur within futures and having to deal with that some of the stuff. But at the same time, there is a place for them, at times, and that's something that, of course, other people are using them, and they're using them, and that's maybe a little bit better for them to So, Chris, you can probably speak on that as far as the difference between futures and options, and futures and ETFs, and why we tend to focus more on that ETF side.
Well, it comes down to use of capital. We are a fund for the long term, believe in holding assets, and futures are, yes, it's a replication vehicle for the index, but it's not, just doesn't fit our persona and the type of investor that we're looking for. And it's an additional step having to roll that out every single time. There's no question in that. So again, we believe in hard assets, sitting somewhere at a good custodian, and that's really what our focus has been.
And Chris, you mentioned earlier too that just some of the issues you brought up on the options-oriented panel, and in general, this was not completely 100% options, but there was clearly an options focus to the event here. And as you guys have done a lot of outreach with clients and things, and now you have your first CIO conference here in sunny Puerto Rico. What was the response like when you were reaching out to people initially and saying, "Hey, come to Puerto Rico and we'll talk about options and their use case in a portfolio setting"? Was there a lot of people? Were they hesitant, or were they excited to come and learn more about the options component of that? What was kind of, or were those issues you talked about earlier, were they kind of giving people some pause?
No, I think everyone was pretty excited. I think everyone, well, first of all, a chance to come down to San Juan, Puerto Rico, and just check it out and see what's going on down here. But anytime you have an opportunity to learn more about options, anytime you have an opportunity to help your own portfolio or your clients or your understanding, it's just going to make the whole industry a better place. And, we're engaged with many different people, financial advisors, RIAs, and it was just an opportunity for different, like I said earlier, I was impressed with the diverse array of participants, a lot of different people giving their spiel, and really everything kind of related to what we do, ETFs, options. We talked about liquidity in the options. So we touched upon a lot of different things that, we have to deal with on a day-to-day basis when we're managing our book.
The other thing, going back to the ETFs for a second, too, another thing that caught my eye here at the conference, again, this morning on the ETF panel. He kind of brought up another contentious topic in the ETF world lately. That is, of course, the performance of some of these products post and on August 24th, and in all of the froth we saw. Subsequently, we've seen a lot of push from the regulators, push from the public, and others saying, hey, what's really going on? A lot of that was in kind of the more levered universe of the ETFs, these 1/3 ratio type inverse and other type products. So that's where I think a lion's share of the headlines and the issues were with those things. But still, they brought it up this morning. It was an interesting topic, and they kind of explained some of their thoughts. I'd be curious. You guys obviously are very active in the ETF world. Still, mostly in SPY and relatively liquid products, so it hasn't really been an issue for you. But I'm curious if this is kind of something that's come up over there in Swan as you're looking at different allocations in the portfolio. Maybe does that start playing into the ETF consideration a little bit, going back to the ETFs versus futures? Maybe that's a kind of an unknown that's hard to quantify in a chart of roll yield versus management fees, but it maybe is something lurking on the horizon again down the road.
We do look at those things, but I also liked what a couple of guys who've been in the industry for a long time, said, they're, in the trading field, from Wallach-Beth and the other gentleman that's also been on trading for a long time. They were saying, look, sometimes these things can happen for a little bit where there's, some exchanges that are coming off and there's some, less liquidity there, and now they're not pricing a few of those stocks because they're, hey, what's going on? We just want to wait a second and get our, collect ourselves. And then, of course, if those stocks aren't getting priced right, then the ETFs aren't either. But generally, that's a very short time frame. And then, as the trader said, look, when we see this type of thing happening, we just, hey, let's sit back for a second, let everybody calm down. And then what generally happens is, of course, the ETFs start to act like they're supposed to act, which is, bid and ask, they start coming back in, prices start coming back in. But yeah, it was a very abnormal event. There's been quite a study on it. There's I think it's like a 70, 80, maybe even longer page report out from the SEC on that particular day. I've seen a couple other great studies on it that I looked at. There were a number of ETFs that really had a harder time than others. The QQQ, the NASDAQ ETF from Invesco was actually one of the ones that I was really looking at as very unique in what happened. It basically gapped down about 17%, 17% on that. So it's a flash crash. It's like the flash crash we saw in May of 2010. Most people just didn't think about it or see it as a flash crash because there were less that this occurred, and it was right at the open. And then the recovery from that was pretty immediate. It was with minutes. So within 5 minutes, I think the QQQs were then down only 6 or 7%, which is still a pretty major decline to open the day. But that's also to show the point of what these traders were saying and what they're seeing on the markets is, if some exchanges back out and they're not providing the data for a little while, and then they do come back in, you're better off, if you're trading options on those ETFs, you're better off on days like that, to sit back and relax, wait for the market to settle down, and don't try to thread the needle and overreact on a couple of minute move that's occurring. We've seen these days occur a couple of times now, I think, in the last perhaps a year, something similar, not to that as great as we saw in August last year, but as some of the traders mentioned that were talking about it, they said, we see this once a month sometimes on an ETF or a stock. So it's happening every now and then. I think if people understand it, keep an eye on that, they also, it's nice to hear that the regulators are looking at this and saying, hey, what happened? Do we need to change something? Make the exchanges work together to where they can't all do this separately, that they have to, do things at the same time. There's different things that they can do to make it happen less frequently. So I don't know if you have anything to add on that.
Yeah, well, one of the points I really liked, there's this old saw in the industry that, buy on the rumor, sell on the news. But Andy gave a good counterpoint. It's like, well, there's lots of noise out there. There's lots of false rumors. There's lots of things that just simply aren't true. And he cited the example where someone on Twitter posted that the White House had burned down, and then the market went into an immediate panic. But it took them maybe, all of 30 seconds to realize that was a bogus announcement. And, if you had panicked and hit the sell button, well, then you just look foolish. So I think his advice is very good. Keep your head, catch your breath, and don't just, have such an itchy trigger finger.
Yeah, so, what we're talking about are short-term strategies, and that's not what we do here at Swan. We have a long-term perspective and goal. So do we have to deal with these? Are we watching the market every single day? Absolutely. So are we part of these events? Yes, but do we overreact like what it seems like the rest of the world is doing at times? No, we don't, because we stick to our long-term program that we know that has succeeded for so many times. I mean, this program has been around for 18 years, so it's taken a lot of events. Funny though, we seem to focus on the last ones, the very short term, because they seem to hurt a lot of people, but we've been through this before, many times.
We've seen these events before, like we said, May 2010, we've got, 9/11, what happened there, we've got...
Long-term credit, all the way back to 98, we were there for that.
And 2008 almost had a handful themselves, and different things passed or didn't pass in Congress. So yeah, we've seen these things
is it
before.
safe to say they're probably going to continue?
Yeah, they're going to happen again. And we're ready for them.
Yeah, we have not seen the last of these flash crashes. Call them what you will, breakdowns, all sorts of fun stuff. Yeah, gives you guys something to do during the day. Keeps your job exciting, right? Yeah. At the end of the day, let's end on this. Then it's kind of been an interesting event, and we kind of thought about some interesting ideas. But maybe we'll go back around one last time. Any last thoughts you have that kind of came to mind for you about this year's conference, and maybe some ideas you may have, some things you might like to see. It sounds like this is going to be an annual event, so maybe some things you might want to think about for next year's event.
Well, the one that was certainly on a topic that people were kicking around a lot and no one's got real clarity on it is what is the Department of Labor going to do with the treatment of financial advice and the fiduciary responsibilities. And I know this is going to impact a lot of people in a lot of different ways. I mean, if you're in the financial advice community, this impacts you. But as of today, at this very moment, the details are still not published. I mean, there's lots of rumors, there's lots of speculation, and some of the individuals that were here at this conference did give feedback to the Department of Labor and say, hey, this is what we think. And certainly when it comes to the options world, there were some rumors that there would be some severe restrictions as far as what people could do in the retirement accounts. But then, other people said, like, well, wait a minute, people are using collar strategies or they're using protective puts, which make total sense in the retirement account and are actually conservative strategies, not speculative things. And then again, the actual rules.
Very close.
Yeah, the airport is very close, but the actual rules have not been published yet, and it's going to take a while for those things to be published, for people to digest them. And the rumor is that there's going to be an 8-month period before people can actually implement all these things. So I reckon by the time we do this again next year, this will still be a topic. I mean, we'll have a little bit more information to work off of, but where we go, who knows?
Yeah, that's been obviously a very contentious topic on this program in particular on our network. I can't recall a program a topic on this program in particular that got so many disparate people in our audience up in arms. We see it from the advisors, obviously, but a lot of retail who may have heard this on this show came in and where they were furious about this. Why can't I buy a put in my IRA? It makes no sense. So yeah, there's a lot of vitriol on this topic. Frank mentioned from OIC down at the conference. He made another interesting comment. I think it was on your panel, Chris, about the Department of Labor also has some prohibitions against education from an options perspective, which that's being deemed apparently as advice in this new proposal. Another thing that seems completely backward. You want to, if these products are so dangerous, you're restricting them. Maybe you want to educate people about how they work. So there's a lot of counterintuitive things in that proposal. We debated it a lot on this program in about Q3 of last year, and it seemed like it was settled out for the most part. It seemed like the industry had spoken, the public had spoken. Look at the comment letters on that. There were your proverbial Aunt Agnes from Iowa wrote in on that one saying, I want to write my calls in my IRA. So there seemed like there's a unanimity of opinion against it. It seemed like the Department of Labor heard that and they were responsive. And now here we are. It was supposed to come out in March. We're recording this in early April. They still haven't come out. And it doesn't seem like they're backing off from that proposal, which kind of makes me wonder a little bit. It seemed earlier on that it was kind of just a bit of an oversight, a sin of omission on their part. They really just didn't include them in the list. That's fine. You can't list every asset. I understand that. But now with all the pushback and all the even from both sides of the aisle on the Hill, it seems like they're digging in for a fight on this. And I don't really understand why. That's not a political program, so we won't speculate on motives. But it's just it is an odd thing that they really want to fight on this one. And so it seems like there's going to be. You're right. This is probably not the last we've heard of it. Whenever the rulings come out, all sides seem like they're gearing up for a fight on this one. So it's going to be an interesting next few months, I think, on that front.
Well, if they're cracking down on education, you're going to have to watch your back there, Mark, because they're coming after you next.
That's why we're a publisher. We get to get away with some fun stuff here. Micah, maybe same question for you. Some last thoughts on the conference and maybe some interesting topics you'd like to work into next year's event as well.
Yeah, but well, next year I'd really love to see more. Obviously, we'd love to see. We had a great turnout, but I would love to see more financial advisors come in who are using options, and just because one of the great things I like about these types of conferences is just getting to talk to other people and hear about what they're doing and learn from it. Iron sharpens iron. So yeah, it'd be great to have, I think, some of those people here that are talking about the different ways that they're using it with their clients, learning from those different strategies and the different ways that people are using them. There's so many different creative ways that you can use options. There are almost endless possibilities. So the fact that there's a lot of smart people out there that are using them in very unique and creative ways. So I think we can find more ways to bring some of that in, to have some of that, because, as we said earlier, this wasn't about trying to, have a solid day of pitching. Here's how what we do. Of course, we talked about what we do. We like what we do. We think we're really good at what we do. But we also believe that it's very important to research, to analyze, to study, to learn from other people, hear what they're doing, converse, talk with other experts in the industry, get better at what we're doing through that. So hopefully we'll, next year we'll have more of the same, maybe even better.
That's true. It's that one question, that you never thought of from that one random advisor who comes to the conference, and it could lead you down a very interesting path in the research or with the strategy that that you wouldn't have received if you hadn't heard that them. So yeah, right. That could be certainly beneficial down the road. Chris, we'll bring it home with you. Same question for you. Some final thoughts on this year's event, as well as maybe some ideas percolating for next year.
Yeah, we touched upon a lot of different topics here. I'll be honest, I'm an options trader, so if it was up to me, it would be a complete conference 24/7 options trading. So I'm glad at least I got to moderate one panel here. But moving forward from Swan, I think what you're going to see is new products. Again, like I said earlier, we're going to grow with this business, and the business is going to grow with us. So hopefully we'll be presenting new products down the road, in addition to what we've built so far. So.
Well, it's been an interesting event. It's certainly been a great location to have it. There's been freak blizzards in Chicago while we're down here, so certainly can't be upset about having to come down to San Juan for a few days. And again, I'm looking forward to see what you guys cook up for next year. This was an interesting event. I'm looking forward to more of it, and we'll see more of you next time on The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.